The world as we have grown used to it functioning has changed. And the sooner people realize that, the better.
Are we, in your view, already in an economic war?
Yeah, I think we are. You now have to think through your portfolio and at least understand, okay, if war breaks out, where could I get hurt? What do I need to adjust? What do I have to do on day one? But as soon as the Americans froze Russian central bank reserves after they invaded Ukraine, as soon as they did that, that was what I call the end of the financial world as we know it. And as soon as you view the US slightly differently in that they are not 100% trustworthy partner from here in perpetuity, you have to take steps to mitigate any potential damage to you. And that's what I think is happening. And gold is going to play an enormous part in that. If you push too hard down these geopolitical roads, you can run into problems that aren't purely financial, aren't purely trade-based, and you might find that people have to push back rather than want to push back. And that potentially, that's the thing that worries me. There will be a lot of people who've grown up on the buy the dip that think this is a dip, and there's a real danger in that.
Before we get started, this isn't financial advice. Know your risk tolerance, do your own due diligence, and speak to a financial advisor. All right, so markets are unraveling rather quickly. We've just seen one of the worst three-day trading stretches in decades. And overnight, I think a lot of investors now are starting to realize just how fragile things in the global economy really are. So during crazy times in the market like today, you want to talk to someone who's seen the cycles, who understands history, and still has the clarity to think independently, because there's a lot of noise out there. And Grant Williams, to me, is that guy. With over 35 years in global finance, he's worked across all major financial centers, co-founded Real Vision, and is the author behind the publication Things That Make You Go, one of the most thought-provoking and credible macro publications out there in my view. Grant's a well-connected investor, a sound money advocate, and most importantly, someone who's not out there chasing trends or headlines, but instead digging into the underlying structural forces that are actually shaping the markets. He is a macro investor through and through, and I've wanted to have this conversation for a while. So with all the market chaos unfolding in real time, I don't think the timing could be better. So Grant, welcome to the pod.
Aaron, that's a wonderful introduction. A very, very long-winded and nice way of saying you need to speak to an old guy, which I appreciate that you didn't use those
Exactly.
words. But yes. And I'm at 40 years now. Geez, that's why the hair's grey. I'm only 43.
You got a nice head of hair still, so you're lucky for that.
Oh, it comes off. It's dishwasher proof. It's fine. It just comes straight off.
Nice. So I want to start this off with what everyone's feeling and thinking about right now. Obviously, the markets are rattled. Sentiment has turned on a dime. The previous 3 trading days were, again, amongst the worst we've seen. Is this Trump tariff sell-off just a shakeout or the start of something much bigger? And I also worry, was this crash or correction inevitable anyway?
The simple answer is I don't know, and nobody knows. We just don't know how this plays out. We're surrounded by certainty in markets these days, which is a very dangerous thing to have whenever you're trying to invest your capital. So we don't know. And I think that's incredibly important, because things haven't changed this week over last week. They haven't changed from Biden to Trump. They haven't changed when the calendar year turned. When I say things have changed, I mean the world as we have grown used to it functioning has changed. And the sooner people realize that, the better. And we're all kind of starting from scratch again, because the world is going to be reshaped in ways that we don't really understand yet. We can speculate, we can guess, and we can take our best swing at what's going to happen. But the simple truth is we don't know. All that we do know is the change. So when you look at whether this was inevitable, I mean, anytime you have the kind of run we've had and you get the kind of bubbles we've seen and you get the kind of overvaluations and extended gains that we've seen, a correction of some sort is inevitable. The question is, how severe is it? How prolonged is it? I gave a presentation last year a few times called Who Are You? And it was an attempt on my part to try and get people to ask the most basic question before they even think about markets and what's happening with the tariffs and corrections and buy the dips and sell the rips and all that kind of stuff. And that is to look in the mirror and decide who you are first. Because this last week or so, if you're a trader and a proper trader, these are the days you live your whole life waiting for. These are your chance to make money. These are your days to use the lessons you've learned, the hard knocks you've taken, the losses you've made, the experience you've gained, to remove money from the markets and put it in your own pocket. If you're an investor, these are the days that will absolutely challenge your intestinal fortitude. And so the first thing you have to understand is which of those are you? And there are so many people who call themselves investors who are really speculators. And I get that, because saying I'm an investor, it's kind of cool, right? It sounds weighty, it sounds thoughtful, it sounds like you're smart, and you have a process and a strategy and a framework and all these great things. Investors have those, and speculators don't necessarily, particularly when you think about speculation as it pertains to gambling. It's much more reliant on chance, it's much less thoughtful, less considered, and so it doesn't sound quite as cool, because if you make money speculating, people might think you just got lucky. If you make money investing, people think you're smart. So there are a lot of people out there that call themselves investors who are really speculators, and vice versa. There are people who think they're speculators, think they're traders, but they don't have the mindset for it. They don't have the ability to just cut a loss immediately it goes wrong, no matter how big it is. If you're down 10% in a day, it might be the best thing you can do is to cut it, but you need the right set of skills for that. So these markets are going to challenge people in ways that they don't fully understand yet, and it's going to challenge the very core of who you believe you are and the skills you think you possess. Because if you have the right skill set for this market, this could be some of the best times you're ever going to have. If you have the wrong skill set for this market, this is going to be the biggest test you'll ever face. And you have to understand what you're going into, a period of being tested or a period of kind of reaping rewards.
Right. If you're a macro investor, and I know there's a lot of research and a lot of analysis required to be a very good macro investor like yourself, but don't you think that involves speculation as well? Like, I consider myself to be a speculator, but I'm very long term.
Right. Okay. So let's talk about the nature of speculation versus investment. Every investment is a speculation because the outcome is uncertain. So let's be clear about that. When we talk about speculation, an investment is a speculation. But what I'm talking about is time preference. What I'm talking about is if you are someone who genuinely doesn't buy stocks but invests in companies, it's semantics, but there's an enormous difference in that. If you invest in companies, you tend to think of yourself as an owner of that business. You're not focused on the stock price. You're focused on the quality, the scaling, and the improvement in the business itself. And if you have the kind of time preference that allows you to look at a business and think, you know what, in 10 years' time, with this management team, with this business strategy, with this plan for the future, this business is going to be 4 times the size. There's no guarantee the share price will be 4x what it is. And in fact, there are companies, I was talking to a dear friend of mine today, and he was talking about how since he last visited the company in person 4 years ago, he said they've quadrupled the size of their business. He said what they've done is extraordinary in terms of the capital they've invested, the improvements they've made, and the state of the business. The share price is the same because no one's paying attention to it and nobody cares. And he's perfectly happy. He's clipping dividends in that time. The shares aren't going down, but the business is getting better. And at some point, that will be recognized by the market. This idea of using the term speculation purely for short-term price movements, it's a little bit nuanced. And I use the term speculator because I'm trying to make a point about the nature of someone's character and nature of someone's tolerance for risk. If we're going to get semantic about it, then every investment is a speculation of sort. But the time preference is the really crucial thing. You take a look at the chart of the S&P, go back 15, 20 years, the chart of the S&P. What we've seen this week barely registers at the top of that ridiculous climb in the S&P 500. Don't let me get shaken out of really good, solid investments that I own at good levels just because the market's volatile. Is the business in trouble? Is the company in trouble? Is what's happening going to materially impact their business in a negative way? Don't get caught up in the fact that the stock's down 10%. Oh my God, I should sell. So it's just a mindset thing. And I think the benefit of experience is I've made I've made so many dumb mistakes because I thought I was one thing and I was another, or I got my position sizing wrong, or I misunderstood the nature of the risk I was facing. All these things, they happen. And they happen. The very best you can do as someone either investing or trading financial markets is do whatever you can to not make the same mistake twice. If you can make that your benchmark and forgive yourself when you make mistakes, but understand why you made it and do whatever you can to not make it again, that's the very best that any of us can try to do.
That's great advice. I jumping back to kind of the macro landscape, and we talk about, like, you mentioned things like, great businesses and staying the course with the great businesses and actually looking at the proper way to analyze if they're growing or not just by the stock price. But layered on top of all this market turmoil right now, we've got, you've been doing this longer than I have, but I've been in it for a couple of decades and I've never seen anything like this. Yeah, I was in it during the great financial crisis. I've seen some pretty significant bear markets, but we've got rising global conflict now. You got Russia, Ukraine, you got the Middle East on multiple fronts, the US and China, which are still, to me, what seems like an almost certain collision course. Are we, in your view, already in an economic war globally?
Yeah, I think we are, and I think we have been for some time. I was talking yesterday to Marco Papic, and we were recording a conversation for my podcast yesterday, and I was reminding Marco that the first time he and I met was 10 years ago, January 2015, and we were in Scandinavia on a speaking tour. The first place we spoke, I think it was either Stockholm or Copenhagen, I can't remember which, we went up to speak, and Marco gave a presentation. It was a terrific presentation, and if you look on the internet, you can probably find it. It was a terrific presentation, but he was talking about a multipolar world and what the rise of China would mean and how a multipolar world would shift everything we talked about. The questions that Marco faced afterwards were very interesting because they were clearly coming from people who hadn't thought about this, and many of whom couldn't really conceive of a world where he could be right. Not that they thought the probability was zero, but it seemed like such a stretch 10 years ago, the things he talked about American hegemony being split. And then I got up to give my presentation, and my presentation, again, this is January 2015, was all about war and the chances of there being another war, proper conflict in Europe or somewhere else. And I went back through the 18th and 19th centuries and walked through the history of Europe and the conflicts that would occur. And this was, you had 150 years where Europe was a constant war. Yeah. And the only thing that changed were the sides. The Germans and the Italians fought the Spanish and the French fought the Brits and the French fought the Spanish. I mean, it was just constant conflict. And that led through all the naval battles of the 19th century through to World War I, when things changed with mechanization through World War II. And then it was like, okay, the danger is getting so big here, we need to put a stop to this. And I'll never forget this. The very first question I received after this guy in the front put his hand up, you could see he was unconvinced. And he said, so are you telling us there's going to be a war? Are you telling us we're heading for another major war? And I said, no, I'm not telling you that. I said, but what I am telling you is that for the first time in probably 50 years, we're not going to have a war. If you'd said to me, we're going to have a war 15 years ago, I'd have said no. 20 years ago, no. You just can't say no anymore with any great degree of certainty. And if the probability of a war, a major conflict, goes from 0% to 5%, and I think we can all agree, given what's going on, it's probably north of 5% now, that's a meaningful enough probability, given the damage that could occur in something like that it's something you now have to have a plan for. You now have to think through your portfolio and at least understand, okay, if war breaks out, where could I get hurt? What do I need to adjust? What do I have to do on day one? And is there anything I can do right now to maybe insulate myself as this probability of a war rises? How do I give myself the best protection I can and the best chance of buying time to square my portfolio if war breaks out? That's what I'm talking about in terms of investment. Those are the kind of thought processes that you need to learn. They're the kind of ways you have to think through. It's not what are the markets going to do today. It's how can I be hurt by these potential outcomes? And those outcomes shift all the time. There could be a point in time where the chance of war is zero. We could all have a kumbaya moment and Putin and Trump and von der Leyen are all hugging over a kebab. I have no idea. But it could happen. The chance of it right now is probably as close to zero as it's possible to get in an uncertain world. So that's the kind of stuff I'm talking about.
Definitely not an abundance mindset at the moment. It's almost a scarcity mindset from an investing standpoint.
Yeah,
Would you agree with that?
I think, and those are two perfect words to use. Abundance and scarcity, first principles of investing. And scarcity is more important because in times of abundance, everybody makes money. And the biggest crime you can commit in investing is big drawdown, is giving up a significant portion of your capital because you weren't attuned to the risks you can have, because making it back is way harder. So scarcity is, I think you're right, we're moving we have moved from a time of abundance to a time of scarcity. And so there are significant and elevated risks now. And it's not that the S&P futures might open down 3% tomorrow. Those are not the risks you have to face, unless you're a trader who is swinging the bat and betting on a bounce tomorrow and then another fall the next day, and you're trying to time these intraday swings. And there are people who are very, very good at that, and they make an awful lot of money, never more so than they're going to make now. Most people, in my experience, do not have the skill required to navigate those kind of markets effectively.
Yeah.
And you make one slip, it's like walking across a tightrope.
Yeah.
You know, it's not the slip that will kill you, it's when you hit the bottom. And that's a big problem.
Yeah, agreed. Look, most people lose money trading stocks. It's a very difficult thing to do. I am a buy and hold investor, speculator through and through. That's the game that I like to play. So now that we've got, Trump throwing fuel on the uncertainty fire with these tariffs, I mean, he just said he's going to bump up China's to 104% now. Historically, tariffs have created geopolitical tensions and in some cases, been a reason to trigger wars. Do you think that this kind of policy shift from Trump is good or bad for gold? Because I know you're a gold guy, as am I, and so is our audience. Because we talk about scarcity, we talk about preparation. The natural inclination is when you think shit's going to hit the fan, you go get some gold.
Gold is such an interesting asset. It really is. I've been fascinated by it for a long time. 22 years ago, I bought my first gold. But to me, and I've spoken about this before, it was a solution to a particular problem that I felt was going to threaten me, and that was the loss of purchasing power over time because of slashing interest rates and what was then, QE. I spent some time in Japan, so before QE was in America, we'd seen it there, and that was clearly the path that central banks were going to go down. So gold was the solution to my problem, which was how do I protect my purchasing power? Before I worry about how do I compound my capital, how do I stand still when I'm actively being debased? And gold was a solution to that. Because gold doesn't have a balance sheet, it doesn't have capex, it doesn't have any of the metrics that people are used to valuing an asset with, whether it's real estate or stocks or bonds, there are inputs you can throw into this that help you understand the value of that asset. Gold doesn't have any of those things, right? It's two things. It's supply, demand, and emotion. That's it. That's what you're trying to figure out. So it is a volatile asset. It does generate emotion, not just in the way it moves around, but also the way it's talked about. If you're not a gold guy, people get quite emotional hearing people talk about gold. Yeah, you're an idiot, it's a pet rock and all this stuff. It's an emotional asset. So because it's largely driven by emotion, the price moves are emotional. And people tend, to your point there in the question, they move towards it when emotions are high and fear is high. When greed is high, people don't tend to move towards gold unless, which is interesting right now, the gold price is going up and there's a lot of people writing about the gold price going up. Then when people do get greedy, they do move towards gold. For me, price of gold is the least important component of it. It just is, because I just don't think people look at the world the right way. People are measuring how much it costs them to buy gold in dollars. It's the wrong way around. If you own gold, which is pure money and which has no liability to it, there's no credit risk, it's everything else is what moves around. Gold is inert by definition. It just sits there in the middle of the financial system. And for many, many years, hundreds of years in fact, gold was the anchor of the financial system. And it sat in the middle and everything was valued against gold. And we've lived our lives in a period since 1971 when that was not the case. But in the 200 years before that, the world was on a gold standard for more years than it wasn't. So the gold standard was the norm. Mm-hmm. So when the pure fiat era was ushered in 1971, it took people a little while. The first thing that happened was gold went from $35 an ounce to $800 because the shackles were taken off. It was suddenly freed. And so everybody focused in the 70s on the gold price. Wow, it went from $35 to $800 and the gold mining stocks went through the roof, as you expect to do. And all this, everyone focused on the price. What was really happening was everything was suddenly being recalibrated in terms of its value against gold. When that happens, it changes the way everybody thinks. And so we didn't get the financialization component happen until there was a bit of a lag, because what happened was people who had basically been on a gold standard for most of their lives didn't really know how to handle the fiat system. They didn't realize intuitively all the levers that it suddenly presented to them and all the leeway it gave them and all the tricks they could pull because they severed that tie between the dollar and gold. So we had inflation and we had interest rates getting put up. So they still hadn't quite seen how low they could go with interest rates and all the things they could do with printed money. They hadn't seen that yet. But once they broke the back of inflation, once rates got to the point where it crushed inflation, we then started this 40-year journey where the nature of a purely fiat system slowly revealed itself over time. And that is at the first sign of any crisis. We don't have to worry about how much gold we have and what we can do, how we're constricted in terms of our response to the crisis. We can slash rates, we can print money. And guess what? It works right up until it doesn't. As we've gone through that 40-year period, they've become bolder and bolder. And the more times they've done this and there hasn't been an obvious reaction that only requires joining two dots, it's allowed them to push that even further. And so when we talk about is it good for gold, most people, when you ask them that question, what they really want to know the answer is the gold price going to keep going up? Is the price of gold, because we're through 3,000, given the turmoil and the margin calls you normally get with a liquidity event like this, gold has performed incredibly well. to stay above 3,000 given what's going on. The question of if this is good for gold, again, if we go back to supply, demand, and emotion, it's very good for gold from those standpoints. It's good for gold from the emotional standpoint because people now realize that there is jeopardy here. There is a big gap between where we are and where markets could trade. We have the Trump tariffs, and look, we're only a few days into this. This is going to have many, many more twists and turns before it's done. But that heightens emotion. Heightened emotion leads to volatility, and volatility leads to demand for safe assets. So it's good for gold in terms of people wanting to own it from the emotional standpoint. From a supply standpoint, it's also good for gold because based on the gold price going to 3,000, we are not seeing a massive flood of new issuance of gold. They can't just dig a load more out the ground. It makes previously uneconomic deposits more economic, but there's a lag in being able to fire those mines up and pull the gold out the ground. It's good from a supply standpoint in that despite the high price, you're not going to see a massive inflow of supply. There will be some sellers of gold who were trading it for the price, so there's going to be turnover, but you're not seeing a massive new supply come on. And then we come to demand, and this is probably the most important one, because the demand I'm talking about is not emotional demand, i.e. markets are volatile, I need to own gold. This is the kind of demand that has been happening since 2022, essentially. And that is demand for an alternative risk-free asset, which is essentially what gold is. Previously, that's been Treasuries. But as soon as the Americans froze Russian central bank reserves after they invaded Ukraine, as soon as they did that, and I wrote about this at the time, that was what I called the end of the financial world as we know it. Because what you did with that stroke of the pen from the Treasury was you said to every central bank in the world that holds dollar reserves, which is every central bank because of the energy link, everyone's either an importer or an exporter of energy, so they're either going to receive or need to pay dollars. You told them all that there are circumstances, no matter how fanciful they might seem right now, but there are a set of circumstances under which you could be deprived of your national reserves. So this is now a national security issue. You cannot leave that door slightly open. You have to find a way of making sure that no matter what happens, you have access to your sovereign assets. If you look at a chart of gold, you will see not just the price, but if you look at central bank purchase and sales of gold, you can draw that line on 2022 when they froze those assets, and you will see nothing but positive bars, and they're getting higher and higher. Because central banks now, it's not really an option. Do you want to own more gold? It's you need to own fewer treasuries. And what are you going to replace them with? Are you going to replace them with Japanese government bonds? You're definitely not. Are you going to replace them with German government bonds? Possibly. And we're starting to see some signs of life in the bond market that suggest. But the only risk-free asset that's nobody's liability is gold. And central banks doing exactly what they should be doing. They are increasing their purchase of gold. They are adjusting their allocation to reserve so that it's a higher percentage of golds, a lower percentage of US treasuries. And that's a problem for the US with the deficits it has. So is this good for the gold price? I think it's incredibly good for the gold price, but it's not the price. The price is going to be a reflection of the things that are good for gold, which is more demand, stagnant supply, and higher emotion.
I was talking with Tavi Costa a couple weeks ago, and we were talking about the Fed. And does the Fed buy gold? And he said, we'll never know because they can't say if they're buying gold because that directly undermines confidence in the US dollar. Do you think that the Fed would be a buyer of gold in these scenarios?
They have 8,133 tons, supposedly. Right, and there's, if anyone's new to this world, if you're bored with JFK and the moon landings, go down the gold conspiracy theory vaults. You'll have a while of a time. But Tavi's right. Tavi's a brilliant analyst in the commodity space, and he's absolutely right. There is absolutely no way that the Federal Reserve can say we are selling dollars and buying gold, which is what they essentially have to be doing. They just can't do it because it will undermine confidence very, very quickly. So again, there are constraints here that restrict the way certain central banks can operate. Previously, the US has been able to wield a big stick and keep central banks in line, whether it's through the SWIFT system, access to the SWIFT system, or whether it's through sanctions from the Treasury. There have been ways in which America can flex its muscle and keep other central banks in line because it was always a benevolent dictator. Everybody acknowledged that the US was the supreme power in the world. Everybody acknowledged that. And whilst they could shove anybody around, they only did it to the bad guys. They only did it to the bad guys. Now we've seen weaponization of the dollar. We've seen sanctions. We've now seen tariffs. We've seen the SWIFT system being used to restrict access to non-favored players. And so again, you're giving incentives and imperatives to former allies to view you slightly differently. And as soon as you view the US slightly differently in that they are not a 100% trustworthy partner from here in perpetuity, you have to take steps to mitigate any potential damage to you. And that's what I think is happening. And gold is going to play an enormous part in that.
It's like I go back and forth on Trump. Is he as smart as a fox, or is he getting a bit sloppy? Like I don't. If I'm thinking how I would do this if I was Trump and I felt like the world was ripping us off, which that's a whole nother thing. But let's just assume he's right in that thesis. I wouldn't go after everybody at once. I don't really understand the logic there. I'm questioning Trump's intelligence on this one. And I think the risk involved with what he's doing, I think, is huge. It just doesn't seem like a well thought out plan, these tariffs. Now, obviously, I'm just a layman looking on, but it just doesn't seem well thought out. What's your take on it? If you actually feel like you are being ripped off, because that's seemingly what Trump believes, going after everybody at once, to your point about trust and even allies questioning if we can trust them, like Canada and the EU and so forth. Like this is a lot of damage. This is a lot of reputational damage that Trump's done by going after everybody at once and bad-mouthing allies in the media. The strategy just seems messed up. I guess what I'm trying to say is Trump smart or not with this? It doesn't seem very smart to me.
There's the scene in I forget which Godfather it is, when they line up killing all the Dons at the same time. If you're going to go after everybody, it actually, in some ways, makes sense to go after everybody at the same time, right? Because if you kill one guy and the other three getting killed, they are going to get together and come after you. It's slightly different. It's apples to oranges. But what you said there is interesting, Aaron, because I think what we all do is this. We all say, I don't know about Trump. Is Trump smart or is Trump dumb? All of the decision-making, all of the negotiations, all the discussions that are being had amongst an awful lot of credentialed people inside that administration come out of the orange man's mouth. So what we're actually hearing is thoughtful deliberations, hopefully, being explained to us by a guy whose syntax, to me, is perhaps the greatest crime he's ever committed. And it's difficult. It's difficult for people. It's if you're a Trump supporter or not, it's very difficult to make the argument that he sounds smart. Because I think objectively he doesn't. He might sound like he's your guy, and he might sound like he's got your best interests at heart, and he might sound like he's making America great. He might sound all these things, but it's very tough to make an objective evaluation and say, man, this guy sounds smart, because he just doesn't.
Yeah.
So that's a problem, because you're trying to communicate very complicated policy decisions through a mouthpiece that starts with a 25-yard handicap in a 100-yard race.
And the smartest, most powerful money people are listening to every word he says, basing their strategies for capital allocation on it too, which is dangerous, right?
I take issue with that slightly. I think the very smart ones are absolutely not doing that. I think the very smart ones are actually sitting back and saying exactly what you and I are trying to kick around here, is that this is early in the piece. Everybody said take Trump literally but not seriously, and now they're saying take him seriously but not literally. And the very smart guys actually have got themselves in a position where they are not being whipsawed around by this every day. They're in a position where, let's see what he actually does. We know what he's saying. We know what they've done with the tariffs so far, but that's the first part of the game. The danger to me is that Trump, and again, depending on where you listen, supposedly Besant has come out and said that 50 countries already called at the weekend to negotiate tariffs, and Taiwan's cut tariffs, and Vietnam cut we haven't seen a meaningful country do it yet in terms of trade balance. I mean, they're all meaningful countries. And China's gone the other way, and they're, as to your point, ratcheting up tariffs. But we haven't seen the end of this first phase, this negotiation phase. That's going to continue. And what we have seen is Trump's lack of willingness to back down, which is, I think, a problem. And as far as I can tell, and I am no tariff expert, I have not gone from a COVID expert to a volatility expert. The whole point of my podcast is that I don't know these things, and I want to speak to people who do. So I'm not an expert. But as I look at this and I think about what I'm seeing, the thing that I worry about is that Trump is taking the tactics that have worked very well for him in real estate deals and worked very well for him in his first term in office in terms of slamming things out. He didn't obviously go to the tariff route, but he was very forceful, and he's boasted about it in Art of the Deal. This is how you do it. You make outrageous demands, and then you eventually settle on somewhere close to what you wanted. We know that's his MO.
Yeah.
And so does every country on earth, because they've seen 4 years of this already. The danger here, I think, is if you take that negotiating strategy, which works for financial transactions, and you start using it to negotiate geopolitical agreements, I think there are national imperatives that don't allow people to perhaps take the purely financial decisions you need them to make. The danger for me is Trump's taken 4 steps forward. He doesn't want to take any back, but if people come and he can save some face and say, hey, we've got to deal with this guy, we've got to deal with that guy, that plays well to him. And it's spinnable because America is such a big customer for all these countries. It's spinnable for them domestically, saying, look, we're still going to be on top with America. It's the same way that Nixon couched the end of the gold window. The dollar in your pocket is worth the same tomorrow as it's worth today. Ultimately complete nonsense. Yeah. But it played very well. So optics are important, but ultimately, if you push too hard down these geopolitical roads, you can run into problems that aren't purely financial, aren't purely trade-based, and you might find that people have to push back rather than want to push back, and that potentially, that's the thing that worries me, using this kind of negotiating tactic for geopolitical negotiations.
Let's say, this onshoring of manufacturing plan, let's say it even works without causing extreme inflation. I think all it would really do is just speed up the process to automate and for robotics to take over the manufacturing sector. Like the way it's being pitched is we're going to bring the manufacturing jobs back to America. Everybody's going to have a great job. It's going to be like the 1960s again or whatever. But the reality is no, it's not. It's going to be robots doing the manufacturing. At least if they were able to pull it off. And so to me, it's not the win that it's being pitched to be. Sure, it'll increase productivity and so forth, but I just think the messaging has been quite misleading. And I think putting guys like Lutnick out there in front of the public is probably the worst thing he can do. I'm not a huge fan of his delivery, but kind of staying on that topic, how do you see inflation playing out then for the rest of the year? Is it too hard to tell at this moment?
If I may, let me just touch on something you said there.
Please.
Because I think it's important. And I say in my conversation with Marco yesterday, he very politely explained to me why I'm an idiot. So my belief going into my conversation with Marco yesterday was that the thing that helps Trump here is that there's a lag. Because he can do all this stuff and he can promise people that because of what I'm doing, the jobs are going to come back. And because of what I'm doing now, here's what will happen in the future. Inflation will stay low. You're going to get big, beautiful jobs back. You're going to build big, beautiful things in the Midwest, and everything's going to work. That's what got him elected, were those promises. And now he's standing up doing exactly what he said he was going to do. He's making America great again by making America big and bad and bold and bullying the world, right? Which to a lot of people is what America should be, right? We are the biggest, baddest country on the planet, and we should be dominant. And I get that. I totally get that. And my contention was that there is a lag between Trump taking these measures, and there is a window during which he can promise, here's what these measures are going to do. And people will give him that period of time because they're going to say, well, the jobs don't come back tomorrow, but Trump's keeping his end of the bargain and yada, 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 jobs come back. And how long the yada, yada, yada is anybody's guess, but that period gets shortened once prices start rising. Because once prices start rising because of this, people suddenly get a lot more angry a lot more quickly. That was my contention going into my talk with Marco yesterday. He disavowed me of that notion, saying that if you look at the polling data, that window is incredibly short. I figured it would be 6 months, maybe even a year he would get, unless prices started to go up dramatically. Marco said there's no way. It is much, much shorter than that. And in fact, the polling data already suggests that his support is wavering amongst the people because they don't really care about tariffs. They want jobs. They want the things he's promised them. If that's the case, and Marco's way smarter than I'll ever be, so I suspect it is the case, then that, I think, could be problematic. Because I don't think you get this honeymoon period where all the fire and brimstone plays well until the second order effects are not coming through the way you hope they would be. So again, we're in this period of incredible flux, and you can find different ways to come at this with different outcomes. The important thing to do is to not get wedded to one and say, well, obviously this is inflationary or obviously this is deflationary, and then completely ignore the other side of the argument because it could go either way. And yes, tariffs have been inflationary, and yes, people make case how they've been deflationary. We just don't know because it's the reaction function that will ultimately determine the outcome here, and that's still being decided.
So the big thing for me now, like just geopolitically, that I like to, go down the rabbit hole and try to come up with thesis on is China and the U.S. Like how I look at China is they're getting more and more desperate. A lot of smart guys I listen to and have spoken to have said it's uninvestable. Some have said, no, it's a great market to invest in. I'm a bit confused. I'm thinking that at some point they're going to pull the trigger on Taiwan. But when just bringing it back to this, trade war that Trump has ignited, is there any way that China can come out better off because of this, do you think?
Yeah, I mean, absolutely there is. It's a tricky needle to thread, but the United States pushing away a lot of its trading partners and pushing them into China's orbit is a big win for China. Giving China access to other markets because you're joining together in your kind of repudiation of American tactics is a win for China. There are all kinds of ways when this can go well for China. Most of them are geopolitical. I fully suspect that Xi will start stimulating wildly. In fact, when Mark and I were talking about this yesterday, we were talking about how little room from a fiscal standpoint the US has because of what's happened post-COVID. It's all been fiscal, and that's why it's translated so directly into much higher prices. China still has fiscal room, as does Europe. If Europe can get itself together, there's a lot of countries in the world that have fiscal room that the United States doesn't. I'm not by any means saying this is bad for America, good for China. I'm not saying that at all. It could go horribly for China, and China could be in a world of hurt. But it's not a slam dunk that China is going to be in trouble. And it's going to happen quick enough that they come to the table on bended knee. And as well as America's dominance, there is no softer country than America in terms of how comfortable it's gotten with the way of life and the cost of living and all the things that this hegemony has afforded Americans. And of course, the dollar's place at the center of the financial system have afforded Americans a standard of living which, on aggregate, is way above where it probably ought to be. There's a great line in Wall Street. Everyone remembers this line about, greed is good, and there's half a dozen Gordon Gekko quotes, dog with fleas and all this kind of stuff. But to me, the best line in that movie comes from Daryl Hannah at the end when Charlie Sheen has had his kind of come to Jesus moment. And she says, Bud, having money and losing it is worse than never having had it at all. And I think that is such an important thing to think about. Americans going from rich, really rich, like a standard of living the world has never seen in history, to less than that is way worse than the kind of lower class in China getting a little bit worse off. It's a massive step down, and the pressure that's going to come from Americans who suddenly can't afford to eat out 4 nights a week and can't afford to order anything they want on Amazon. And if they do, it takes a week to arrive instead of, taking that away from them is going to be much trickier and much more liable to get people out in the streets, not necessarily justifiably, right? I mean, the idea of collective pain is something that other countries also do better than America. I mean, Japan is the perfect example of this. The idea of collective pain is encoded into Japanese DNA. As a society, they will take pain for the greater good. So, and not that America won't do that, but for America, it comes at the point of we have to go to war, or it comes at the really sharp end of this. It doesn't come at the beginning when someone says, hey, look, Amazon Prime is going up 40% in price this month because we have to. So there's so many ways this can play out, and that's why it's really dangerous at the beginning of something like this, talking about anything other than the possibilities rather than the probabilities, because there are so many possibilities, and the probabilities of all of them are going to shift on a daily basis, on an hourly basis. We saw yesterday this dodgy Walter Bloomberg headline that came out had a $3 trillion swing in equity markets.
Crazy.
That's what we're dealing with.
What does that say about the market what does that say? The Walter Bloomberg fake or false information headline about a delay on tariffs. What does that say about the market, though?
It takes us right back to where we started this conversation. If you're a trader, if you are a trader, a skilled trader, what an opportunity. That kind of swing intraday, I mean, the great traders will have recognized that. They'd have seen the headline, they'd have seen what caused it. They'd have gone, that's not necessarily a done deal. And they'd have taken the other side of that, and they would have made money. Some would have lost, but a lot of good traders would have made a great amount of money. If you, someone who thinks himself as an investor, and you don't have the right time preference, there will be a lot of people who sold positions or bought a dip because they thought this is it, we're going up, and got whipsawed around and found themselves out of control and responding to the gyrations of the market rather than having a plan for this, a strategy they had before this gets, the good traders were going in saying, what if they announce a pause in the tariffs? Because all the talk over the weekend was of that, right? There was a lot of talk that there's going to be a pause. So the good traders had a plan for that. If a pause gets announced in tariffs, here's what I'm going to do. These are the stocks I'm going to buy. These are the stocks I'm going to sell. These are my limits. If it moves 5% on this news, that's the kind of thing that traders do. The people who said, oh my God, my short position in Nvidia that was looking so great, I'm now 20% offside. What do I do? That's not the way to negotiate this. So it's going to be really, really tough markets to make money on an intraday basis. Yeah. There are going to be opportunities that come up that give you the chance to make money on a 5-10 year basis, really good money when things get oversold. You just got to know who you are and know what you're looking for and have a plan to respond to that when it happens.
Yeah, and to your point about, looking for opportunities if you're a long-term investor, which if you look at it, to your point about the grand scheme over the last 15 years, you look at the S&P chart, this is a blip on the radar.
It doesn't register. Yeah, it doesn't register. Exactly. Go back and look for 2008. You can barely see it. Yeah. And those of us that were here for that remember what that felt like. And we remember the S&P falling 66%, right? Mm-hmm. Doesn't even register anymore. And a whole generation of people have come and gone since then. And so the people who are in there now might remember their parents coming home and talking about it, might remember the news, but they didn't feel it. Yeah. And feeling that is very different to reading about it and very different. I'm sure everyone's read about the kind of build up to World War II or the build up to the Great Depression. This is probably kind of what it felt like. And feeling something for the first time is very different. It helps if you've read about it, and it helps if you get a sense of, okay, I kind of think I know what I'm feeling, so I know where to go back in history to read, to get a sense of, after the fact, how it all played out from there. But you have to know what you're feeling first, and there will be a lot of people who've grown up on the buy the dip that think this is a dip, and there's a real danger in that, because the buy the dip will end. That does not last forever. And when a market has changed from a buy the dip to a sell the rip market, you can lose an awful lot of money if you don't figure that out in time.
Yeah, I remember 2008. I remember when we started to get into the heart of it. It bubbled it was starting to form for like almost a year.
It started in 07.
Exactly. And then when it finally kind of took hold and Lehman, went under, it did not matter what happened in the market. Sentiment was just negative for probably 4 or 5 months minimum. And you'd always think, maybe this is going to help the market. And nothing would save the market. There would be little blips, but the trend would remain down, or it would just be flatlined at a really low valuation for what seemed like such a long period of time, because every day you were hearing about, and to your point about how does it feel, every day you were hearing these stories on the news about, this family, this community, or this, small bank went under, and here's all the damage, and then, it's the sentiment really, really can weigh on you. And it's not just what's happening in the stock market. It's when you look around and you have maybe a friend who goes through, financial hardship because of the downtrend. To your point about feeling these downtrends, it is a lot different. It is a lot different.
It is. And there's an important component to this, Aaron. You talk about when Lehman went under and how we had those terrible markets from September till the market bottomed in March of the next year. Yeah. For the public, it was the Lehman moment. It was, that was it. If you were in the markets, if you were at a trading desk or sitting inside an investment bank, it was Bear Stearns 6 months earlier. That was what you remember, because that was real to us. It didn't make the headlines Lehman made because JP Morgan bought it, so it wasn't a failure. But if you were inside the markets, it was alphabet soup funds going in 2007. Yeah. So depending on where you are in the kind of the knowledge hierarchy, and what kind of engagement you had, these changes reveal themselves to different sets of people at different times. And obviously the advantage of being so plugged in that you feel these things and you see them happening before everybody else is that period of loneliness where you see something, you feel that change, and you act on it because that is what all your pre-planning has told you to do, and then nothing happens. That can be tricky. I remember I moved to Australia towards the end of 2005. I sold at what turned out to be pretty much the top of the market. Not because I was any kind of genius, I just happened to be moving countries. But the subprime stuff was on my radar in October of 05, and I went down to Australia and I was talking to the guys I was working with down in Australia about it, saying, this thing called subprime, I think it's a big deal and you need to be aware of it, and I would talk them through how it all worked. And they couldn't give a toss. They didn't
Really?
care. And look, Aussies are Aussies. They're pretty laid back anyway. But the general response was, mate, that's not a problem down for Australia. That's a US problem. We're not worried about that. And it wasn't. And they were absolutely right. It wasn't a problem for Australia, but it was a problem in 2008. And I talked about it through 2006, 2007. And there was more stuff happening. And it was interesting. Once Bear Stearns went under, how many people came up to my desk and said, "Hey mate, do you fancy going out for lunch? I want to talk to you about this." And it was always, "So this subprime thing." That's not to say I'm any kind of genius, because there were people that put it on my radar that were flagged on it before me. And down in Australia, I wasn't in a position to really do anything about it at that point and make any money out of it, because the markets kept going. But I recognized the problem. So when it happened, I could at least say, it's happening, not what's happening. And that's a big advantage if you can say it's happening rather than what's happening, because it means you understand the nature of the risks and you're ahead of trying to figure out. You don't have to figure out what's going on, you figure out how to mitigate it. But that period where you see a risk and you think it's a material risk and it becoming the risk you thought it was is a very, very lonely period, and you can second guess yourself over and over and over again. And all the way through that period, of course, you could be wrong. The risk may not be what you thought, and so you have to have a plan. What if I'm wrong and it's not the risk I thought? So there's so many nuances to this. It's not all about price. It's about having a clear, coherent strategy for dealing with the risks that you think are going to be the ones that might materially impact your portfolio.
And another thing too is that you could be absolutely right about all the risks, but all the monetary invention that we've seen too can kind of paper over it, right? So last question, and this is kind of it's on the same target, but what are the chances that we see, because I'm starting to feel like we could see a serious economic recession, potentially worse. What do you think about the chances of seeing another great financial crisis during Trump's tenure? I just see this as a big issue right now globally with the tariffs and the debt load of the U.S., the rush to gold. He's not getting the results he wanted with the Treasuries either, I don't think. So I just see a lot of things bubbling. I'm very nervous about it. What do you think? We could see a major crash, or is this, maybe there's a correction of 20-30%? Where are we? What risk level do you see for something major happening?
Well, let's bear in mind, we've had a correction of 20% already, right?
True.
We've had that. So, this idea of a crash in people's minds is, the 87 crash was down 22% in a day. So a crash in Hong Kong, we saw Hong Kong fall 11% last night, or the night before last, right? That's a crash. What's potentially more problematic is this slow-moving crash where the markets just keep grinding lower. And they don't necessarily crash because there are all kinds of circuit breakers, and there's going to be all kinds of monetary shenanigans that go on if it looks like markets are crashing. But we come back to this by the dip. A crash could be the markets go down and keep going down. That could be a crash. And you're waiting for the dip. You've bought it. You're waiting for it to bounce. You're waiting for the Fed to do something. You're waiting for what they've done to have an effect. You're waiting for the rip that is coming, because that's all you've ever seen. Right. The rip comes. Of course it's coming. It never doesn't come. It always comes. And it just doesn't come. It's like waiting for Godot, ultimately. You just wait for that bounce, and it just doesn't come. And that's probably more difficult for people, because you need capitulation for these things to bottom. And the slower they are, the less people capitulate. If the market goes down a couple of percent a day, or goes down 3% a week for a month, that's frog in boiling water time, right? It doesn't. You're not panicking. You just go, next week we'll probably rally 3%, and then before you know it, you're down 15%, and then you start going, well, hang on a second, what's going on here? In some ways, a crash is actually good because it's cathartic. It gives the inexperienced and weak hands the chance to puke all the stuff that they're not strong holders of, and it gives the chance for stronger hands to buy those, and it can settle markets down. I'm much more worried about a long grinding market where people over time lose faith that stocks are ever going to go up again. That's I think, probably more of a problem than if we get some kind of crash which throws up opportunities to invest your capital at heavily discounted rates.
That is what a few people are calling for, is kind of this long-term malaise and the S&P underperforming for the next decade or longer. And
well, history suggests that where we're valued now, that's exactly what we're in for. At best case, it's 10 years of sideways movement.
And in such a scenario, where do you put capital to work? What would be a good alternative?
Well, in such a scenario, it becomes a question of impairment of capital is the risk you face, right? If we have stagnation, if we have market stagnation, economic stagnation, your purchasing power is not going to get hurt. And so you don't need to make 10% a year, right?
Right.
So again, figure out what the problem is you have to solve. And generally speaking, the first one you have to solve, because it is baked into the way the financial system works, is the destruction of your purchasing power. That's the first problem. How do I make sure that no matter what I do with this dollar, whether I grow it or not, at least this dollar can buy this hot dog this time next year?
Right.
That's the first problem you have to solve, because they're actively trying to stop you doing that. Once you've figured out a way to do that, and over time, gold has proven itself as a very, very good way of doing that, then you can start thinking, okay, what's the appropriate level of risk to take for a 2% return or a 3% return? And for people who have grown up getting used to 10% returns every year with very little risk, oh boy, is that going to be dangerous. That's going to be dangerous times.
Yeah, well said. Well, Grant, you've given me a lot to think about. I'm more nervous than I was before our conversation, but that's okay. I think we're in relatively unprecedented times. Where can our viewers find you online and learn more about you and take in more of your wonderful wisdom?
Easy, grant-williams.com is the website, and I'm on Twitter, less so these days because it's just become so toxic, but at TTMYGH, which is just the acronym for things that make you go home.
Perfect, Grant. It's been an absolute pleasure. Thank you for taking the time today. I appreciate it.
Thank you, Aaron. Appreciate you having me on. Good to talk to you.